Hello, everybody. Today we are going through our newest quarterly in review, which is Q3 2025 in review and year-end outlook. As usual, we cover most of the major changes in international trade, domestic indicators. We go into a portfolio analysis section. We also discuss structured sales and annuity sales towards the end of the document. What I really want to make clear in terms of the Q3 2025 index performance is that the stock market was exceptional. This is a much different quarter than Liberation Day when we discussed this last. QQQ was up over 10%. S&P was up 8.38% quarter to date. You've had massive AI trade. I mean, you saw the shares of Oracle surge 36% when they captured a $300 billion cloud deal with OpenAI. And we also obviously had a interest rate cut, the first in a long time on September 15th. When the Fed cut, the overnight lending rates by 25 basis points. So we'll get into that section a little bit more in terms of the 10-year and the 2-year. But flows have been really great, and retail in particular in July was very strong. Things to consider, though, is ultimately this is a very deep K-shaped recovery. So the bottom 50% of households are holding roughly 2.5% of household wealth in the country, and we don't really see signs of that changing. I mean, in fact, it might be exacerbated as consumer spending is becoming increasingly top-heavy. Get to the 10-year. We saw 10-year yields decline throughout the quarter. We saw, a softening of the job data. Rhetoric from Chairman Powell turned more dovish, obviously, as well. Our view is that we really shouldn't be cutting rates at the current moment. If oil gets away from us, that is a huge source of what has been disinflationary in a kind of sticky inflationary environment. Apart from that, you've obviously seen services side hiring's been weak, labor market shrinking, and so there is definitely elements of a softening economy, but not to the extent where we think we can really price in these massive cuts, depending on how they play out throughout the rest of the year and into 2026. In terms of labor, we really kind of show, labor force participation, right? In terms of peak ages, 25 to 54, as well as the unemployment rate. And we've seen that there's been a subtle decline in peak labor participation rate. So, aging demographics tend to be leaving at higher rates than young people are entering. Just a few years ago, we were really at highs in terms of peak labor force participation. 3 years ago, you could say this is the highest since it's been since roughly 2000, and that was kind of off of all-time highs. So that's starting to soften a little bit. Obviously, deportations are playing a significant role, as there has been aggressive, and also patrolling on the border. I mean, crossings are at very low, virtually non-existent, and then we're also have mass deportations. You also saw, within the last couple of years of great equity returns, you've seen people, calling it a day and taking the retirement. So that's really tightened the labor market. Unemployment rate has hit 4.3. There's been some downward revisions, as there usually is. But that's become more of an issue with the BLS. And, we're currently in a shutdown. So we probably won't get the most recent labor updates. Gold, as of today, we're recording October 7th. It hit 4,000 an ounce, which is the highest it's been. Part of this, increase is attributed obviously to retail, but there is a lot of central banks who are increasingly comfortable with buying larger deposits of gold. Throughout the year, it's generated a 46% year-over-year price increase. We've seen a 16% quarterly increase as well. So gold has held up exceptionally well, and it's, as Ray Dalio said today, maybe you should start considering even more exposure to the metal. Oil and nat gas, it's been pretty lackluster out this quarter. We're looking at an average throughout the year of maybe $67.65 a barrel when we're talking about Brent crude. Oil faces a supply gut. There's been a lot of reserves in Guyana. OPEC, that decided they don't want to hold back production anymore. That might change here shortly. But, there's just a lot of production going on. And then we also see that global liquid nat gas supply growth is set to accelerate this next year as well. In terms of energy and commodities, I just show that Bitcoin was up pretty modestly this quarter. Ether was up tremendously at 72%. There was a vote on September 7th that kind of discussed the possibility of creating a strategic Bitcoin reserve. That's not a formal thing that's been created. It was more or less opening up to a study. But we think that there's a possibility that the market's discounting that. And we see this chart here. It shows 2023 to 2024, the rise of millionaires and centimillionaires and billionaires in terms of people who are holding crypto and Bitcoin. That has grown tremendously. And when 2025 numbers come in, we expect that to be the case as well. Copper futures have come down quite a bit in terms of a broader global shutdown or slowdown, I should say. Long-term outlook, we remain bullish. We're talking about electrification, talking about solar panels, and we're also talking about the global south becoming a middle income to upper middle income country. So all of that is going to create what we think a tremendous amount of demand. We did see a fatal disaster and closure of the Grasberg mine, which was one of the largest in the world. But we kind of end on the fact that copper is crucial for clean energy. That's the way China's going. That's the way Europe's going. And that's the way the globe more broadly is going. And with that, I'll open it up to the 5 key questions we have for quarter 3. And Tim, how about we get started on the first one, which is, will the rate of inflation accelerate or slow?
All right. Thank you, Drew. Look, our view overall on inflation is that the rate of inflation is going to continue to accelerate. We are not of the opinion that the U.S. economy is going to re-accelerate, but we also don't think that we're crashing down into a recession. We use the HOPE framework, housing, orders, which is kind of demand and consumer demand specifically in the economy, profits, and then employment. Housing is critical to that. But we do not see a housing environment that is weak enough that is going to take us into a recession. And the fact is that housing has provided, and there's an essay that we put in here, the housing market and the inflation serendipity, the benefit that we've gotten from the fact that we've had a little bit of housing weakness, and that has taken a lot of pressure off of shelter and OER inflation. So the fact is that if we get less disinflation from housing, if you actually start to see rents going up a little bit on a national level, and you do have a multifamily market that has super tightened up. Everybody likes to talk about, and Stephen Mirren especially likes to talk about, that with less immigration, you have less demand for housing. Well, guess what? Go to any job site in this country. Go to any multifamily or single family job site in this country and tell me if supply isn't going to be impacted by having deportations and far less immigrant labor. The Fed has done a lot of work around that concept, and what they have found is it's a wash. So I just disagree with Mirren's view that there is a disinflationary impact to lower immigration. The housing market is tight, and I think it is going to remain tight in most of the country. Are there going to be pockets of real weakness in California, in Texas, in Atlanta, and especially in Florida? Yeah, I think there will. But in the Northeast and in a lot of major metropolitan areas in this country, housing is tight. And, the whole idea of the handcuffs that people like me have who are empty nesters with a mortgage below 3%, we're still not going anywhere. So you still don't have meaningful existing supply. And now you're getting new supply in the single family, in the multifamily market, really coming to a trickle. So the fact is, in my opinion, is that shelter disinflation is slowing. So services inflation has been where all the inflation has been in our lifetime, right? There's been no goods inflation. We got a whole bunch of goods inflation during the pandemic. Well, now with tariffs, you have goods inflation again. So if you don't have shelter inflation dropping and you have goods inflation accelerating, well, guess what? Overall headline inflation is accelerating. And the forecasters, the economists who do the micro work that I follow, who I think are outstanding, they see inflation, and I see inflation accelerating through October, through November, through December. And you absolutely can see that across the goods areas where there are high levels of imports. We've also written a lot about and followed on a lot of academic work that really shows that companies raise prices when they can, not when they necessarily have to. Now, to those who don't believe inflation is a problem, who have argued that tariff inflation is ephemeral or maybe not even showing up at all, I will grant you that the rate of tariff inflation being passed along to consumers has been slower than I and most would have expected. That doesn't tell you a damn thing about what the tariff impact is going to be as companies can pass that inflation along to consumers. I covered the consumer product space and the housing space for a lot of years. And I can tell you that in consumer products and in housing supplies and the cost of building housing and doing maintenance and refurbishing housing, there is a lot of inflation there. And all of the intermittent goods, aluminum, steel, prices are going higher, meaningfully higher in the United States. So I still believe, and I have just as much conviction as ever, that inflation on the goods side is going to continue to accelerate. And I think that the relief that we have gotten from housing on the inflation side is actually slowing. So you are going to have both services and goods inflation going up at the same time. And I think that the 5 cuts that are still priced in to the end of this year and next year are going to continue to fade away. So that's our view on the inflation side, and that is a hurdle for these markets and the economy to overcome. The second big question is employment inflecting weaker as the Fed believes, right? The 10-year ripped lower. The 10 years went higher, 10-year yields went lower since Jackson Hole. And I was as surprised as others when Powell was as dovish as he was at Jackson Hole. What's interesting, though, is that you have seen the 10-year go higher since the Fed cut rates. And I think that what has happened since then is you've had inflationary data look a little hotter, and you have had the jobs data look a little stronger. You've definitely got pockets of weakness in employment, but you also have much of this economy where the labor market is tight. And again, I think the impact of the supply of labor, you talked about it a little bit earlier. Yes, we have deportations. We have very, very little immigration, but we also have the aging demographics. And as you said earlier, when you have a lot of people my age and older that are leaving the labor force in part because they've become a lot wealthier than they ever expected they would. And while prime age workforce participation is pretty high, there's a whole lot of labor that isn't in that prime age native-born domestic workforce. So I actually think as long as we don't slide into a recession, the only way I think we slide into a recession is if there's a market event. In other words, the tail wags the dog. It would be market weakness that begets economic weakness, and that is going to be inherent in an economy that is so reliant on the top 10% and the top 1% of consumers. So I see a scenario where employment actually stays pretty firm. Look, we've already had a long period of declining single-family home construction, of declining multifamily home construction, and guess what? 50% of respondents in the construction industry to the National Federation of Independent Businesses, who survey them every month, still can't fill open roles, right? And if you look at the aftermarket, and I wrote an essay on this topic, Talk to anybody who is in HVAC, in plumbing, in doing home remodeling, and ask them how it is trying to find labor. Ask anybody who runs a restaurant or a services business like that, and ask them how it is to try to find labor. The labor market is tight. The unemployment rate is 4.3%. That is not the non-farm payroll data. That is the household data. And if you and again, look at what's happened with initial jobless claims. There's basically been no lift. You had the one scare with the Texas fraud claims and all that we got on CPI day. But otherwise, you have a tight labor market, and I think wage growth continues to pressure services. When you look at that ISM Services Index, the most recent one that we got, where the Mendoza line of growth versus contraction is 50, you're seeing 70 numbers. That's an extraordinary number in those series. That is a number that is telling you that service businesses are paying more for all of their inputs, and their biggest input is labor. Let's go on to the next question, Drew. The third is, will the dollar break to new lows, and will that lead to pressure on risk assets? This is a super interesting question. Markets aren't always intuitive, right? If somebody said to you, look, this administration is going to be pursuing essentially a weak dollar policy where we're going to try to suppress interest rates below even, Stephen Mirren would argue below the rate of inflation is where interest rates should be going. And we'll even entertain the idea and talk about Treasury Secretary Ann Mirren have talked about using yield curve control type tactics in order to suppress the long end. I would tell you that the dollar would be making new lows, but it is not currently making new lows. Now, we're bouncing along the bottom of about a 5-year trend, and maybe we will break. But me and my every uncle I know and everybody I know believes the dollar is going to break lower. So you get positioning that is already overwhelmingly betting against the dollar. I am surprised that U.S. risk assets are as strong as they are when you have an overt weak dollar policy. But just like we had happen in the early spring this year, where you had an exodus of a dollar investment and you had, dollar down, yields up, gold up, U.S. risk assets down, I think we could see that again. Look, right now, investors are looking at the U.S. and looking at the AI trade as the only game in town. Everybody suffers from FOMO. It's your neighbor suffers from FOMO, but so does the most sophisticated risk manager, portfolio manager, running a European-based pension fund. And it's hard to keep up if you're not long U.S. risk assets. Well, as soon as that stops being the case, and we are still pursuing the kind of the debasement trade, as it's called, then I think you do have real risk. And again, this is another area where I think it could be the market that wags the economic dog. That if you have foreign investment, which is at all-time highs, coming out of U.S. dollar assets, you could get the kind of flush that we saw earlier in the year repeat itself. It's not a base case. I'm not making this prediction. My hair's not on fire. I'm just making the observation that it is hard to believe that when you run a weak dollar policy, that is not going to dissuade foreign investors from maybe lightening up on what is a meaningful overweight. The argument here isn't that everybody is going to go underweight the U.S. Everybody in Europe and Japan and China is going to go underweight the U.S. It's just that they will go less overweight than they are. If you want to keep up in managing money, you better own some NVIDIA. You better own some Oracle. You better own some AMD. You mentioned Oracle was up 40%. Hell, AMD was up 28% on a trade. But when that starts to come off the boil, I do think there is risk that you will see people say, look, I need to own less dollar-denominated exposure. Let's go to the next question for Q4? Is the oil market tightening, and will geopolitics, and by that I mean Israel, Iran, and Ukraine, Russia, have an impact? Look, as you alluded to before, all of the inflation that we've got, all of this inflation pressure, this rebound in inflation, CPI and PCE rolling back up through 3%, that has come with oil at $60. It's kind of hard to believe, because if you know history, you know that inflation pressures tend to go hand in hand with oil. Oil's in everything. Oil drives the global economy. And it's hard to think about having really meaningful inflation pressures when you have such a quiescent oil market. Well, one of the risks I see in that, and we've talked a lot about this, and my friend and neighbor Arjun Murti, who was and still is probably the best oil analyst in the world, he is on this theme of, look, global demand. The IEA gets it wrong every damn year. Oil demand is going higher because it's really only about 1/8 of the global population that meaningfully is pulling on that oil demand. Well, there are 6 or 7 billion more people on this earth who every year, more and more of them become part of the global middle class. They have a tractor, they have a moped, they have a car, they have a refrigerator. They are going to pull on global energy supply. And that is an inexorable demand. Now, look, we're probably oversupplied right now. Technology has had an incredible impact. Look at how much more efficient the lower 48 has become. But shale is getting pretty mature, and oil companies are loath to spend money with oil down around $60-65. There was a great commentary out of the Dallas Fed survey that really made it very clear that the oil market in the United States, oil executives are not going to spend more money. They are not going to give up their discipline. They are going to preserve their money. They are going to return free cash flow to investors when oil is below $65. Now, oil, the OPEC countries have resumed drilling, but the question of spare capacity and their willingness to spend even amid a kind of a weak oil market is unknown. I also think, and I think this is becoming more of a mainstream opinion, that oil as a weapon and the ability for small entities, whether we're talking about Houthi rebels or we're talking about not a small entity, but the Ukrainian army, to use drone technology to interrupt the supply of oil and oil products, that is an issue that is every day is becoming a bigger threat to the supply side. And there's always that day that we're all kind of worried about where the Straits of Hormuz get closed. And that is something that can happen without meaningful technology, without meaningful spend, right? Look at how effective the Ukrainians have been at shutting down oil export capacity in Russia. Look, it is impossible for any entity, even the United States, to protect every mile of pipeline, every storage facility, every offshore storage facility, every refinery, right? There are millions of miles, of square miles of this capacity in the world, and every day it becomes easier for an entity to interrupt the ability of those facilities to operate. So I think that the risk premium in oil, there's always the risk that comes back in, and you have at least temporary interruptions to the supply side. The fifth and probably most important question that we ask going into Q4, Drew, if you could just pull that forward, is will anything slow retail-driven passive flows, right? Michael Green's term, and just as a reminder, Michael Green is going to be on the podcast on the WealthVest Bull and Bear here in October. We're thrilled about that. The giant mindless robot, right? Not only are passive flows flowing into markets and distorting valuations, driving the valuations of the mega caps and pushing down in relative terms the valuations of small caps and mid caps, but you also have retail participation at all-time highs. What is going to change this? Well, a meaningful recession would certainly change that, right? That would slow passive flows. Eventually, demographics will slow that as more and more retirees who have all the money, as they retire, as they get into 75 and they get into their RMD years, that will slow passive flows. But more in the immediate term, it is AI optimism, right? And as we started this year, we quoted Dan Niles saying the biggest determinant of the outcome of markets this year is going to be AI optimism. And up to this point, AI optimism has done nothing but build. But we have written some pieces recently that really question what is going to be the return on investment. We point to the Bain study that makes the argument that, look, there's a very good chance that we are not going to actually have the energy capacity to support all of the AI and data center build. There is the David Einhorn question of what exactly is going to be the return on investment of all of the AI spend. And at this point, we don't know. But right now, all retail knows is there's momentum, and that FOMO is real. And my neighbor just made a whole bunch of money long Oracle, and my other neighbor just made a whole lot of money long AMD. All of the children cannot be above average. There will be creative destruction. There will be winners and losers. And despite the distortion created from passive flows, ultimately the market over the short term is a voting machine, and over the long term, it's a weighing machine. And while passive flows distort that, over time, I still believe, maybe I'm old-fashioned, but over time, markets are going to be a weighing machine, and there's going to have to be a proven return on investment to the literally hundreds of billions of dollars that are driving this market, and by the way, contributing maybe 100% of economic growth in this economy right now. So look, those are the 5 big questions we have. We don't believe that we have the answer to all of those questions, but we think it's important for us to help you as financial advisors, you as investors, frame that debate. And we're always available to help you talk through and understand these concepts.
Awesome. Thanks, Tim. Then we kind of start to wrap up the document in terms of the international outlook. Europe has been relatively strong. Last quarter, obviously, was much stronger than the relative American counterparts. It's begun to cool down a little bit. Last quarter, you saw a huge influx in terms of defense spending. So you saw big winners like Leopold and then different European defense contractors. This quarter, it's gone down. It was up 5% in Q3, Euro stocks at least. And we still continue, which has been somewhat of a longstanding trend right now, is the traditional sick men of Europe, which is also defined as the pigs, Portugal, Italy, Greece, Spain. All those markets are up quite a bit. We're looking at Italy's FTSE was up 8% quarter to date. Spain's IBEX was up 11% quarter to date. You're starting to see some real trade tensions and low growth in larger economies like the UK and Germany. France is in a debt crisis, and there's quite a bit of political and civil unrest in a couple of these markets, but we're expecting slow and moderate growth for the rest of the year. In terms of China, China's tech has really taken off. Chinese QQQ was at 34% up this quarter. That really helps highlight the Shanghai Stock Exchange, broadly speaking. But we ultimately see them moving into the global AI race. They have a lot of advantages when it comes to critical minerals, but we think that their real estate market is still mired in a slow and painful decline away from their major metropolitan cities in the eastern seaboard. And then also we think that the Chinese consumer has been really unwilling to spend right now. They're definitely in a saving category. This opens us up to the geopolitical risk that we see. What I want to talk about this quarter broadly was what is happening between the U.S. and China, but also what does that mean for India? So in response to, non-compliance in terms of Russian oil embargoes, we have put tariffs on India. Broadly speaking, these tariffs are totaling 50% and 25% are deemed as reciprocal for what is considered a longstanding trade imbalance. And then another 25% of that is also due to India's continued import of Russian oil. This has really upset Modi and India broadly. You saw they traveled to China for the first time in 7 years in August 2025. When you're looking at these two countries together, China and India jointly make up 35% of the world's population. And in terms of GDP by purchasing power, they're making up 28% of the world's total. In the early 2000s, 2008, the strategy was the pivot. We were going to move away from Europe. We were going to move away from, the Middle East, and we were going to focus on strategic alliances in India and Southeast Asia broadly, whether that be Vietnam, Indonesia, Philippines, South Korea, what have you. But that has become increasingly difficult in our opinion, due to externalities. The Ukraine-Russia conflict is definitely one of these externalities. Trade issues are another externality. And then obviously geography is an externality. We talk about the Monroe Doctrine that exists in the United States. A lot of Asian countries, China in particular, is like, well, why don't we have our own Monroe Doctrine? This is our sphere of influence. Logistically, trade and business relationships make more sense. And so that's just kind of a natural element of it as well, as apart from the kind of political competing factors. For our portfolio analysis section, we revamped our Rethinking Retirement Realities. We do this study every 2 years. This year, we included 823 respondents from all across the country. It was census weighted. Some of the major takeaways are that investors remain concerned about inflation. They continue to have a conservative risk disposition, and income generation is valued more highly than accumulation potential. And I should note that these respondents are retirees or near retirees. It's 45 years and older, right? So when you look at what are you most concerned about in the economy, valuations is second, but we see that tariffs is kind of runs the risk. So it's a lot of inflationary pressures. And we're looking at whether they respondents envision a potential recession as a deflationary one, run-of-the-mill recession, versus more of a stagflationary environment. We see more respondents are leaning towards a potential stagflationary environment. We see a question, any given year, what negative returns are you willing to accept with your retirement savings? These numbers are always fairly conservative, with 34% of respondents saying 0% is an acceptable loss to retirement savings. For producers out there and for financial professionals, this is a huge opportunity to revisit your client's book of business and to see if they are allocated in a higher risk tolerance, environment than they might be comfortable with. And ultimately, income and income generation is incredibly important. 70% of people prioritize that as opposed to 30% of accumulation potential. And you really see in an environment where there's strains on Social Security, Medicare, major, systematic entitlements, that people are really going to look at private pensions and income tools that they can create on their own. Annuities, quarter behind. LIMRA hasn't come out with Q3 numbers and won't for quite some time. But in terms of Q2, which was occurred kind of during the April market sell-off, we saw VA sales fall a little bit as a result of that. But we saw fixed deferred annuities were 11% higher than a year ago, coming in at $45.2 billion. Conservative investors have been bulking at recent stock market valuations and at that time, what was some volatility. And then also these products have remained competitive to CDs. We also saw a strong quarter for fixed index annuities and RILA sales as well. We end our discussion on structured notes. They extended their rally in Q3 at a record high. As time of this publication, $76.64 billion in structured notes sales year to date. We have definitely some headwinds coming into Q4 as we speak. There's ramifications with a shutdown. There's also long-term ramifications for equity markets. And if bond vigilantes come out in force to what we point here as giant budget deficits and a continuation of policy paralysis. But at the same time, there's, obviously upsides and low levels of volatility, continue to weigh in on pricing. But yeah, so structured notes will be interesting coming into this recent quarter and to end the year out. Kind of close with highlights in terms of a podcast we had. Craig Shapiro is one you should check out, and also some of the blogs that Tim wrote. And that's a wrap. Tim, unless you have anything else to add, that's all I have on my part.